Hello, everyone. My name is Brittany Button, and I'm a long-term care insurance specialist at Art Jetter and Company. Thank you for joining us on this highly anticipated presentation from Mutual of Omaha. We are joined by Stephen Alloy, Advanced Market Specialist from Mutual of Omaha, and today, of course, as you know, we'll discuss the tax benefits that come with the purchase of long-term care insurance. Now, before I turn it over to Stephen, I just want to mention that if you have any questions throughout the presentation, you can go ahead, type those into the chat or question box available, and we'll be able to address those at the end of the presentation. Also, as you may have noticed, we do have some handouts available for you to download. Just note, these are based on the 2023 tax deductibility rules. Our team will be reaching out to you once we have the 2024 materials available. So, without further delay, Stephen, let's get started.
Well, thank you, Brittany, and thanks everyone for joining the call today. We're going to talk about something that is fun. We're going to talk about paying less in taxes or getting tax breaks. That's always an attractive topic. And long-term care, as I'm sure you all know, because most of you are actively involved in the long-term care market, long-term care has some of the best tax breaks, tax advantages in our industry. So let's take a look at what some of the tax advantages, the tax benefits of long-term care are. Of course, we have a disclaimer, but you guys know that. Basically, a lot of these tax breaks come from the fact that long-term care insurance is treated as health insurance, which is taxed differently than life insurance. So those of you that do both long-term care and life, there's some significant differences in the tax breaks with long-term care versus life. Well, reason being, this long-term care is treated as health insurance, and as a result of that, health insurance being taxed differently, there are more tax breaks associated with long-term care than there are, say, with life insurance. So this all came about from the HIPAA laws from quite a few years ago, but the tax break, the deduction that someone gets for long-term care insurance premiums kind of depends on who is taking the deduction. It's different if it's an individual, it's different if it's a business, and even within business, there's C corporations and there's everybody else. And then if it's an employee who's getting it as perhaps as a corporate benefit. So let's take a look at each of those. Before we do, though, one of the terms that's going to be important in talking about this is eligible premiums. Eligible premium basically is the IRS designated amount that some of the categories here, most of the categories here that we'll talk about, are able to use as a deduction. So you may notice I've got the 2023 numbers and the 2024 numbers. Now, 2024 is really more for informational purposes. The tax returns that your clients are doing in April, filing by April, would use those 2023 numbers. But you can see, interesting enough, the 2024 eligible premiums went down slightly, $10, $20, $30 here. Not completely sure why, but they're slightly lower than they were in 2023. So, but those are the amounts, and as you can see, they're age-based. They change basically each decade of age, past 40. So that's the amount that most people are able to use for a deduction. But let's take a look at really how that works. And this will all be in the materials, that some of which are available now, some of which will be available in the near future, the 2024 numbers. So for individuals, if it's someone just buying a policy on their own, they can deduct the premium, the eligible premium, up to 7.5% of their taxpayers' adjusted gross income. Well, basically it would become a health expense, a medical expense. And if all the medical expenses equal or exceed 7.5% of the taxpayer's adjusted gross income, then they can deduct anything above that. So you'd basically add the amount of premium in and combine that with all other medical expenses. Now, to do that, the taxpayer does have to itemize on Schedule A. So one of the problems that's come up, and one of the reasons that a lot of people maybe don't see a direct benefit from this, is the tax bill from 2017 made several changes. One of them was the standard deduction basically doubled. So most people now, in fact, according to the Congressional Joint Committee on Taxation, 9 out of 10, I think it might even be between 9 and 10, it's probably more than 9, but not 100%, but pretty close to 100% use the standard deduction. So they are in a sense getting a benefit because that benefit is factored into the standard deduction that they're taking, but they're not seeing a direct benefit perhaps from the long-term care premium that is added to their health expenses. Now that's all scheduled to sunset at the end of 2025. So we'll have to see what happens. Don't know really what's going to happen. I mean, it could sunset before that. It could wind up continuing after that. They could keep the standard deduction at the current rate. Hard to tell, but stay tuned. The next couple of years should be interesting. But that's why I think a lot of people maybe it's not top of mind that they're getting a tax deduction for this because they're not itemizing, but if they did itemize, it would be considered part of their medical expenses, part of their health expenses. For business entities, there are basically two categories. There's C corporations and there's everybody else, and everybody, which includes LLCs, S corps, sole proprietorships, any other partnerships, any other business structure. They are all what's considered self-employed. So let's take a look at the distinctions between them. Let's look at self-employed first. So basically, anybody who is involved in a business that is not a C corp is another way to think of this. Or is not taxed as a C corp. They could. Some LLCs are taxed as C corps, not very many, but you do run across some that are. Anything not taxed as a C corp is considered self-employed. And for S corporation owners, shareholders, they have to be greater than 2% to be considered, a self-employed owner. So basically, how that's treated, again, the eligible premium is the amount that they're allowed to deduct. But the nice thing about being in the self-employed business owner category is that they can take that eligible premium deduction without having to conglomerate that in with other medical expenses. They don't have to hit any particular target. They basically can take that deduction off the top. If that's their only medical expense, they can take that. So up to the eligible premium. Back up. Basically, how that works is that it'd be whatever their premium is, as long as it's at or lower than the eligible premium. If their premium is higher than the eligible premium, they can only take that eligible amount. But they can take that basically as a straight deduction. They don't have to combine that with medical. They don't have to have any other expenses. They can take that directly. So C corporations, it's a little bit different. C corporations can take the actual premium, C corporation owners. So that'd be the shareholder, employee. Now, it can be the owner, but the owner does have to be involved in the business, has to be an employee of the business as well. It can't be an absentee owner. But assuming it's a shareholder employee, that shareholder employee spouse and any other dependents could take the actual premium. So if you have the most expensive plan you can imagine, that's well above the eligible premium, C corporation owners can still take that deduction. So that's kind of a nice thing for C corporations. You don't run into a ton of C corporations anymore, but when you do, basically when you run into a C corporation, I would think long-term care, because they are treated so nicely with the long-term care rules here. Companies can carve out long-term care insurance for executives. Get a lot of questions on this. You do have to be careful, and the second bullet is really important. The companies, the business owners should work with good counsel to ensure that they're following state and federal laws, particularly ERISA. They're not running afoul of ERISA, where they wouldn't be able to carve out. They basically have to offer it to everyone. But as long as they do it right, they can carve out a class of employees, such as the top level executives or whatever other class of employees, and can offer long-term care insurance to them and not have to offer it to everyone in the company. So that's kind of it's a nice benefit that's available with long-term care as well. And probably the best result is if you're an employee. I mean, C Corp's pretty good, but if you're an employee and the company is providing long-term care insurance, or as the payor, let's say, of your long-term care insurance, the business can deduct the actual premium, really whatever structure the business is, as long as the employee involved is not an owner of the business. If it's just an employee, company can deduct the actual premium that they pay on the employee's spouse, and the other dependents. The employee doesn't have to include that in income. Again, there's a distinction with life insurance where, if you have an executive bonus life insurance policy, you do have to include that as personal income. With this, you don't, because of the health insurance classification, and the benefits are still income tax free. Really doesn't get a whole lot better than that. That's pretty good. So if you have an employee that the company is the payor on their policy, that's probably literally, I think that's the best of all treatments here. As I mentioned, the benefits, and I'm sure you all know this, that the long-term care insurance benefits are tax-free to the extent that they don't exceed. Let me back up. Most policies now are reimbursement. You do still see some endowment policies, but most are reimbursement. So as long as they're reimbursing for qualified long-term care expenses, it's a tax-free benefit. But assuming that you're just getting cash, then it would have to not exceed either the cost, the actual care expenses, or the per diem amount from that we looked at on that first page, which I guess $420 per day, and this year shrinks down to $410 for 2024. So as long as the cash amount out of the policy did not exceed that, then that would still be a tax-free benefit. Anything above that could be considered a taxable benefit, though. So there's some other tax considerations and other questions that sometimes come up. Can you pay premiums from a health savings account? Yes, you can. How about from a medical savings account? Yes, you can. How about from a health reimbursement account? Yes, you can. So pretty good news so far. Well, news gets not as good with these. So can you do it from a flexible savings account or from a cafeteria plan? Unfortunately, no, because in part because of the tax benefits of those accounts, where, if the money is going into those accounts pre-tax, then it can't be used to fund what is going to be a tax-free benefit. So, that's one of the reasons that you can't from those plans. But from the other plans, yes, you can. We sometimes get questions on 1035 exchanges. And under the law, this law goes back to the Pension Protection Act, I think, of 2009, 2006, and that was effective in 2009. You can do a 1035 exchange from a life or annuity into a standalone long-term care policy. It is legally allowed. Now, it's one of those things when we get the question, can we do 1035 exchanges? The answer really is yes and no. Yes, it is allowed. Now, one of the problems is most carriers, including us, won't do that. Reason being that the IRS was one of the questions that came up at the time that this became the law. One of the questions was, well, can you do multiple 1035s? Can you do an annual 1035 out of, say, a life policy to fund this? Is that still a valid 1035? The IRS promised that they were going to get, some detail on that, some guidance, and I know they've been busy and they're short-staffed, but it's been a long time and we don't have the guidance yet. So I think a lot of carriers are in the absence of any guidance, are just saying, well, we're just not going to do it because they don't want to have years and years of setting this up. And then the IRS comes in and says, oh, yeah, no, none of that's valid. So we have to undo all that stuff. So it's one of those things that, yes, in theory, it's allowable, but you may have trouble finding a carrier that will actually do it. One workaround that I know some people have done is they basically will do a 1035 into a SPIA, and then they'll use the SPIA payments as the annual to pay the annual premiums. You know, that 1035 works. So that could be a workaround for this. But as far as a direct transfer, you know, that's hopefully in the future we'll get, maybe we'll actually get some guidance on that someday. A lot of policies include return of premium, and then a lot of times we get the question, was that a taxable event? Well, that's another maybe. That's a yes and no also too. If premium is refunded and it wasn't deducted, if somebody maybe never itemized or didn't deduct the premium, didn't take the deduction for the long-term care premium, then that would be a tax-free return of premium. That would not be taxable. To the extent that they've taken the deduction, though, which maybe it'd be the eligible amount or whatever deduction they took, to the extent they took a deduction, if they get that back, that would be then taxable. But if they've, this is maybe one of the side benefits of the higher standard deduction, where it's harder to get that direct deduction for the long-term care. Well, the side benefits is, well, your return of premium is more likely to be tax-free because you haven't taken the direct deduction for it. Occasionally we get questions on gifting, and gifting, of course, the gifting amounts go up each year. This year is 17. I think next year is going up to 18,000 per donor per recipient. But on one of the nice exceptions is for medical gifting, medical care gifting, there's no limit. It is unlimited as long as it's directly paid to the provider. So it has to be directly paid. Say if somebody's going to gift, well, for medical care, it has to be directly paid to the hospital or the doctor. For long-term care premiums, which would be considered a medical expense, that would have to be paid directly to the carrier, to the company. So as long as, if someone's gifting premium, as long as they pay it directly to the carrier, and again, they will only get the exclusion up to the eligible premium. But as long as they do that, then they're not limited by that 16,000, 17, 18,000 of annual gifting. A lot of states have some really nice tax incentives and tax breaks for having long-term care, because I think a lot of states are realizing that they can't afford to have people not take care of their long-term care expenses and just rely on, I'll go on Medicaid. They started to realize, that's not going to work. We're not going to be able to afford that long term. So a lot of states have some really nice tax credits for having long-term care premiums. Typically, this is going to be states that have a state income tax. So if your state doesn't have a state income tax, it may not be as great a benefit, or they may not have any benefits. But if you have a state that has a state income tax, then yeah, a lot of them do have some really nice benefits. I would check out the AALTCI website for changes in that. Our time today, I don't want to go through every state. I know if anyone's calling from New York State, I know New York's got a really nice one. California's got a really nice one. So there's some pretty good state tax benefits out there. So it's definitely worth checking out. Speaking of states, and a couple of the states we mentioned here, I'm sure everyone has heard of, if you've been in the industry, and paying attention, you have heard of the Washington State, the WA Cares Act, and the WA Cares program going on in the state of Washington. Essentially, it's a state-based long-term care program that is designed to, the motivation for it was, again, as we were just talking, Medicaid they realized, hey, we need to do something to at least delay, if not maybe eliminate some of these Medicaid costs. So they established a payroll tax on anyone who's employed in the state of Washington. There's fairly minimal benefits. 36,500 lifetime benefit is available. I don't know that that's going to cover a whole lot of care, but they have been collecting the payroll tax for pretty much 6 months now, and claims could start as early as the beginning of 2025. So they're building up some of the funds now. Reason I bring this up is, I mean, most of you probably don't live in the state of Washington, but a lot of other states are looking at doing something very, very similar. And in fact, as time goes on, most of the proposals are remarkably similar to the state of Washington, the WA-CARES proposal. I think it's been a little quieter on the state front this year, in large part, I think, because California, kind of the big player in this, they had a task force that came up with recommendations, and then they've spent most of this year looking at with an actuarial study. They have the actuaries taking a look at what each of those proposals, there are 5 different proposals, what each of those is going to cost. And they had at least planned to have the results of that actuarial study out by the end of the year. So it should come out relatively soon here. So I think a lot of states were kind of waiting to see what California did. I suspect once that comes out and once California starts taking some action, which would be into next year certainly, once they start taking some action, I think some other states will start to get on the bandwagon too. So just something to be aware of. I mean, I certainly don't want to panic anybody, but I think to the extent that exemptions were allowed for people that had long-term care coverage in Washington. And there's a lot of talk, they may or may not be included in other states' plans. But to the extent that they are, I think, if someone can get good care, really the care that they need, the care that is going to matter for them. And a lot of times that might even be less, depending on their income, that might even be less than they'd pay in the payroll tax. So if they can get good care and get out of the payroll tax, I think that's much to be done, much to be recommended to them. But stay tuned on that. That is a developing story in a lot of different states. The Secure 2.0 made a lot of different changes, most of them to retirement accounts that really don't impact long-term care. It did have one change for long-term care that it'd be interesting to see. It may not make a huge difference, but it is kind of a nice addition that effective about 2 years from now, a retirement plan like a 401k, for example, can distribute up to $2,500 per year for the way the law says, certain LTCI premiums. The LTC policy has to provide what the bill calls high quality coverage. Now, we don't really know what that means. I mean, I think we know, sort of in a folksy sense, we know what high quality coverage is versus non-high quality coverage. We're not really sure what that means. I think some guidance, hopefully they're going to be a little quicker on this than they will on the 1035 guidance, but hopefully there'll be some guidance on what that means. I suspect that most of the policies that are out there that are partnership qualified, I suspect that's what they mean, but we don't know that for sure yet, but I suspect that's what they mean. Nice thing about this now, the $2,500 that comes out of the retirement accounts, that is going to be a taxable distribution, but for people that are under 59 and a half, they will avoid the 10% tax penalty on that. So it'd be interesting to see. I mean, on the one hand, a lot of people that buy long-term care insurance aren't that much under 59 and a half in a lot of cases. So it may not be that big an incentive. But on the other hand, somebody that's notably younger, this might wind up being an incentive, saying, at least it's a way to find the money and maybe get it when they're in their late 40s or early 50s, and knowing that they can withdraw this from the retirement account. It's it'd be interesting to see. I mean, it could wind up being a nice benefit. So we'll have to see once that actually kicks in 2 years. Another great tax benefit, if you have some clients that only applies to kind of a limited range of clients, but if you've got clients that qualify for this, clients basically, they're in a retired public safety employee retirement plan. So that's police, firefighters, EMTs, things like that, first responders. They can withdraw up to $3,000 to purchase long-term care insurance. And again, it's got to be paid directly to the insurance carrier. So that's a nice benefit. Now, again, it only applies to a limited range of clients, but kind of a nice thing if you have somebody that does meet those criteria. I mentioned the partnership program. I'm not going to talk a lot about the partnership program, just in the interest of time, and also you guys probably are more familiar with it than I am in a lot of ways. So, but it basically, the partnership program, I see that as an asset protection tool. I see long-term care in a lot of ways as asset protection, but I think the partnership program is more directly asset protection. Policies that qualify under that program, basically every dollar of benefits that's paid is going to protect an equal dollar amount of assets, assuming they exhaust that and then qualify for Medicaid. So they'd exhaust the policy benefits and then apply for Medicaid, but they would be able to hold out more assets than someone who didn't have this coverage. So it's a nice, again, a nice benefit that goes with long-term care insurance. And this is our long-term care team. I mean, certainly you've got quite the long-term care team right there at our Jetter. So certainly they can probably handle most of your questions, but certainly we're glad to talk with you as well. Brittany, I don't know if there were any questions that came in, but if we got a couple minutes here, maybe we can answer some questions.
Yes, so it looks like we have a few comments and questions here. So I had somebody ask about the state tax deductibility. So I will reach out to you personally. I do have that list of in a PDF.
Okay.
So definitely we have that information handy, and we'll be able to get that out. So I had one person inquire, but if anybody else would like that listing of the state tax rules and deductibility, we do have that available. Oh, here's a good one. Got some people asking about a group long-term care plan and if Mutual of Omaha offers one.
Well, I'd like to say yes, but I can't. No, we don't, unfortunately.
So Stephen's correct. Unfortunately, there's not a group offering at this time. Who knows? Future may change. But for those interested in, you never know. But for those of you interested in a worksite type product, sorry, Stephen, but we do have availability on some plans and solutions outside of Mutual of Omaha. So definitely reach out to our long-term care team here at our Jetter, and we can assist you that way, seeing if we can get a solution for a particular group you have in mind. All right, next question came in. Okay, kind of figured this would come up regarding hybrid long-term care life solutions. Now, folks are asking if they have the same tax deductibility benefits. Stephen, do you want to comment, or I can tackle this one? It's up to you.
Well, I'll comment a little, and then you can, if you want to add some things, go ahead.
Perfect.
It's one of those maybe questions. Most of them, including ours. I mean, we have a long-term care rider on some of our life policies, and ours, and I think probably the majority of carriers, based on the way that it's paid, it does not carry the same tax deductibility. The fact that it's paid, because ours, and I think a lot of, probably most of the carriers out there, is paid from cash value in the life policy. So that is not able to be isolated and deducted separately. There are some carriers who have filed it differently, and it is paid separately. It's actually collected, I guess it's all collected at the same time, but it is segregated from the life premium. So those, there is a deductibility for those. Those could be treated like long-term care insurance, but those are, I think, rarer maybe than the ones that can't. I don't know if you have anything to add, Brittany?
Yes. So big footnote. While we don't give out tax advice, we always recommend talking to your tax advisor, CPA.
Yeah.
Typically, you'll want to look in the illustration, and if that carrier does break out that premium. So, for example, One America's Asset Care, Nationwide's Care Matters, in most states, not all, and then Securian Financial Secure Care 3. You will see in their illustration, they have a value for the life insurance, value for the LTC rider, and some even break it out value for the inflation rider. So anything categorized that you'll see in that LTC segment can play by the same tax deductibility rules. And that's why we really call them hybrid solutions, kind of what Stephen was talking about, really be careful on the true life products with an LTC rider, because again, that's a little bit more rare, as he mentioned.
Yeah.
Again, same tax deductibility rules, you're just not having the whole premium available in order to do that. So definitely, I'm more than happy to have a one-on-one conversation with folks that would like to delve into that more, just to save time here and get you all back to your day. So last question, I'll tackle this. Yes, for those of you who have joined the session today, you will be getting an email now. It's coming from the GoToWebinar system. It's going to be about an hour. We got to get everything kind of edited and processed and get it through the system. But within an hour, you'll receive an email from GoToWebinar, and it will have the recording of this. Now, please do not share this recording. This is individual and personalized for you specifically. We don't recommend sharing this as tax bills change, tax laws change. And so we just don't want the spread of possible misinformation in 3, 6, or even 9 months down the road. But you will receive a recording, a link to the recording of the replay while it's still active. Now, when this information becomes obsolete, we will take that down. So with that, Stephen, want to say thank you for co-piloting today's session, and also to everyone who took time out of their day to join us live. So we encourage all of you to start thinking about people, and especially business owners, that could benefit from the tax deductibility opportunity. Also, before you go, make sure to download those handouts we provided. If you don't get a chance to, again, let our team know. We'll get those in your hands. But again, thank you. Our team's going to be standing by after the session. We can be reached at 800-228-0008, and my extension is 1007. My partner in crime, Trenton, can be reached at 1003. So y'all take care and have a good afternoon.
All right, thanks. Thanks, everybody.